Hey everybody, it is James National Realty Centers, and today I'm going to be breaking down some big economic news that has been making waves across the country and here at home. The Federal Reserve just made another decision on interest rates, and I'm going to explain what it means for inflation, housing prices, and your next move if you're buying or selling in Michigan. Now, if you're wondering whether rates will go down soon or whether or not now is the right time to make a move in real estate, this video is for you. For real support and real results, visit my website at realvaluelistings.com, DM, or call me. Now, number one, let's start off with the headline. The Federal Reserve Chair Jerome Powell and the rest of the Fed voted to keep interest rates unchanged again. They are being cautious because even though inflation is cooling down just a bit, it's still not where they want it to be. The earliest we might see a rate cut now is sometime in the fall, possibly September. And even then, the Fed says they likely will only get one or maybe two major cuts this year, and most likely only one next year. And yet the stock market is still going strong. But behind the scenes, inflation and global instability are keeping the Fed on high alert. So why is the Fed holding off on rate cuts? It comes down to three letters: CPI. Now, CPI stands for the Consumer Price Index, and it basically measures how much prices are rising for everyday goods and services, things like gas, groceries, rent, and utilities. And in the most recent report, CPI rose only 0.1% from the previous month, and the annual inflation rate is now at 2.4%. That's actually better than expected, and it's the lowest year-over-year increase we've seen since 2021. So here's what that means in plain English. Prices are still rising, but much slower than they were a year or two ago. And most of the price increases last month came from housing. Rent and shelter costs are still high, up about 3.9% compared to this time last year. And meanwhile, energy prices, gas, electricity have actually dropped about 1%, which is helping to keep inflation in check. So now, the lowest year-over-year increase we've seen since 2021 in CPI, that seems like good news, right? Shouldn't we be seeing cuts? Here's where things get a bit tricky. Even though inflation is trending in the right direction, it might not stay that way. One reason is tariffs. Some tariffs have already gone into effect, but we haven't seen their full impact on prices yet. Why? Because many businesses bought their products ahead of time to avoid the higher tariff costs. So that means the real effect of these tariffs might not show up until later this year, probably causing a fresh wave of inflation. So the Fed chair, Jerome Powell, has warned that if tariffs stay high for too long, they could lead to three things: higher inflation, slower economic growth, and more unemployment. And if that happens, the Fed could be stuck in a tough spot needing to fight inflation without making the economy worse. So, in short, they are waiting. They want to be absolutely sure that inflation is under control before cutting rates. If they cut it too early and inflation comes back, that could rattle the markets even more. So at their June meeting, the Fed released their updated forecast for where they think things are headed over the next few years. They now believe inflation won't return to their targeted 2% until after 2027. They also lowered their expectation for economic growth. GDP is now expected to grow only 1.6% in 2026. And even by 2027, they still think the federal funds rate will be around 3.4%. What does that mean? It means likely the interest rates will stay higher for longer. So whether you're looking at mortgages, credit cards, auto loans, lower rates may not be right around the corner just yet. So aside from national news, what does that mean for us here in Michigan? So let's bring it home and see how it's affecting our local market. For buyers, higher mortgage rates mean higher monthly payments, but there is a silver lining. In many states, including Michigan, although it has worsened in other states other than Michigan as of late, homes are starting to rise in inventory. So the inventory market is starting to increase, giving buyers a little bit more negotiating power than you had just a year ago. So if you got good credit and a solid plan, you might be able to find a great deal right now, especially as more sellers start to adjust their prices. Now, for the sellers, it's still a strong market, and Michigan's median home price still increased about 5% from last year. So, well staged, well priced homes are still selling quickly, especially in Metro Detroit. So, here's how I see it. If you are a buyer, you don't have to rush, but it is smart to be active. If you have a need for a home and you can afford what you're looking for, get pre approved, shop around, and be ready to act. And if rates do drop the next year or two, you can always refinance. And if you're a seller, you're still in a good spot. Just know that buyers are watching their budgets closely. So we have to price homes realistically and have the best listings by having them clean, staged, and priced well. So, bottom line, the Fed is playing it safe. Inflation is cooling, but not gone. And for Michigan homeowners, that means opportunity is still out there as long as you make smart moves. If you're thinking about buying or selling, or you just want a cleaner picture of what's happening in your local market, reach out anytime. I'd love to help you plan out your next steps. Thank you so much for listening. Again, this is James with National Realty Centers.